So with that, I just want to talk to you really quick about the benefits of multifamily investing. Um, what you get with those frameworks is consistent double-digit returns, even in fluctuating markets. And that's what's great about it, because once you have the apartment complex, it really doesn't matter what's going on in the market. Welcome to the Stephen Lee Thomas Show, where we provide expert advice for real estate entrepreneurs. And I'm your host, Stephen Lee Thomas. And it wasn't that long ago that I was navigating the challenges of real estate investing, learning from my mistakes, and building the business I have today. I created the show to give you simple, actionable, step-by-step strategies to help you do the same. Each week, we bring you in-depth discussions with industry leaders and professionals who share their knowledge and practical tips. So sit back, take notes, and let's dive into today's episode. All right, welcome back to the Stephen Lee Thomas Show. And today I want to talk to you about the proven recipes for double-digit returns in apartment investing. And I want to start with why earning a double-digit returns is so critical for your financial freedom. There's a formula we're going to look at. It's a simple formula, and it's how to double your money in 5 years or less. And so there's this formula called the rule of 72. So you take 72 and you divide it by your annual rate of return. And that's how many years it's going to take for you to double your money. So let me explain that for you. I'll give you some examples. If you had some type of really low yield investment, 25% return on investment, a 0.25%, a fraction of a percent return on investment. We'll do 0.25, a quarter of a percent return on investment. If you take that number, you divide it by 72, it's 288 years. It would take you 288 years to double your money with that investment. So let's say you have a savings account. Most savings accounts don't pay this much, but let's say you have some type of investment that's paying you 3% annually. Okay. Now, 3% annually would, first of all, inflation is 3+% every year. So you've got to get this out of your head. If you're making 3% on your money, you're actually just barely keeping up with inflation. You're probably actually losing money due to inflation. But regardless, let's say you have your money in a savings account and it's giving you 3% per year. It would take you 24 years to double your money in that savings account. So a savings account does not earn you any money. To get that notion out of your head, like it's not going to do anything for you. Really put some money there, have some cash available, but the money you make on it is not going to really do anything for you. Now, if you get a 10% return, when the stock market is doing really good, which it doesn't do this all the time, but when the stock market is doing really good, 10% return, it would take you 7.2 years, a little over 7 years to double your money. Even that is a slow burn. You're putting a lot of money in, but every time you put 50,000 in about 7 years, it's going to be worth 100,000. So how long is it going to take you to get to $1 million or $5 or $10 million? It's going to take you a very long time to get there. So what you're looking for are investments that will give you about a 20% return on your investment. If you can do 20% return on your investment annually, that means you can double your money every 3.5 years, roughly every 3.5 years. So if I had to pick where I was going to put my money, then I would want to find an investment vehicle that would give me some type of return as close as I could, probably to that 20% return. So with that, that's why I want to talk about apartment investing and these frameworks for getting these returns. So I'm first going to frame this up. If you're a passive investor in apartment investing, or if you want to be a passive investor in apartment investing, you might be a busy corporate professional. You're making, well over 6 figures or really good money. You've got your health benefits. You don't want to go into multifamily investing full time, but you want an investment vehicle better than the stock market, better than your 401k. Now the 401ks, as of the moment of this recording, they're doing pretty good. But if you look over time historically, they're not always that way. And they're still not going to get you 20% average annual return. So if you invest passively in a multifamily deal, if you invest $50,000, my goal is to give you between 80 and 100% return on investment every 5 years. That's going to get you somewhere between 16 and 20% average annual returns. So right there, passive investing in apartment complexes will help you accelerate how quickly you can double your money. Now, I want you to think about this because a lot of passive investors, they'll say, well, can I just do like 25,000? You can. It's a very small investment amount. You have to look at what are your ultimate goals when you're investing passively. And it's really easy to say, I just want to start with a small number. Even that though, you're only going to double a small number. Think about the amount of money that we're told we need to have in the stock market. And you need a couple $1 million in there, right? So maybe even $5 million you need to have in the stock market. So if you invest $25,000 at a time, it doesn't matter which investment vehicle, you're never going to get to that number. And the reality of it is you need millions of dollars to be able to retire and live the lifestyle that you want to live. That's why I'm saying you want to consider an investment vehicle, some type of alternative investment, particularly I believe multifamily, because it's going to help you get those returns and accelerate your wealth growth. Now, if you want to be a deal sponsor or a general partner, then you get those same benefits, but you can actually do that you can 2 to 4x that. So you could potentially get an 80 to 100% average annual return. Now that's a lot bigger number, but it's not for everybody. If you have the time, you want to make that commitment to doing it, then I think that's great. Then you should do it. But if you do it, you want to be all in. It's not easy to be 1 foot here and 1 foot there. Trust me, I've done it. There are ways you can do it, strategize, but they're definitely, if you want to be a full-time apartment investor, go for it. Great returns. If you're happy with where you're at in your career and the other things you're doing and the lifestyle you're living, then passive investing is a fantastic way to get the advantages of this type of investment vehicle. So I'm going to talk through a little bit of a side-by-side comparison. I'm going to show you the differences. Well, I'm going to explain to you the differences of how someone makes money as a passive investor versus a general partner. So do your best to visualize this. So imagine you're putting $10 million, this $10 million deal, you're investing $50,000. If you're a passive investor, the way you're going to make your money is there's going to be distributions quarterly. So every quarter, people pay rent, we pay the expenses, the money that's left over, we will distribute that amongst the investors. You're going to average somewhere between 6 and 8% just on the cash flow piece right there. And so you're going to make your money there. The other place you're going to make your money is when we sell the property. So if I buy a property for 10 million, I'm going to try to sell it between 14 and 16 million. And there's this big lump at the end of that 3 to 5 years. And so then I'm going to give you a large return. You've already got some cash flow. I'm going to give you a large return. And that's going to add up to, you're going to get all your money back. That's going to add up to the 80 to 100% return on investment. Very simple, very straightforward. If you're a passive investor, every quarter you're going to get checks. When I sell the property, I'm going to give you all your money back. Plus, I'm going to give you a big check on top of it. Done. Easy. All you got to do is read the monthly updates on the property. That's all you got to do. If you're a deal sponsor, there's a lot more that's involved. You've got to make the relationships with the brokers. You've got to find the partners. You've got to underwrite the deal. You've got to secure the deal. You've got to raise the capital for the deal. And once you have the deal, you have to manage the asset. There's a lot more work that's involved on these properties. Because of that, you get compensated in more ways. So the first way is there's an acquisition fee, and that's typically 2 or 3% of the cost of the deal. It's because you have put in a lot of work, underwritten the deals, you put money down on the deal, you put hard money down on the deal to secure the deal. And so you're able to make money when you close the deal. You also invest in the deal. So you're going to get cash flow just like limited partners. You also get part of the ownership of the deal. So you're making money there. You also get the asset management fee. So you're making money there. And then when you sell the property, because of the ownership that you've got, you're making money from that. So you're making money in lots of different places, but you're very actively involved. And whether things are good or bad, you are still doing the work. And if that sounds like it's the right fit for you, then that's awesome. If you'd rather do passive investing, that's awesome too. For me, I got started as a passive investor. I thought it was great, and I decided I want to move over to being a deal sponsor or a general partner. So now let's talk about what to buy. The next thing you want to focus on is what to buy. If I'm going to get that money, what do I want to buy? So I would say focus on B and C class properties. A class properties are great. There's generally less cash flow, maybe potential for better returns. But the working class, where you have the higher occupancy, that is your B and C class properties. So you're going to focus on properties built somewhere between the 70s and the 90s, maybe up into the 2000s now, is where you got your good B and C class properties. You want to focus on the middle class and working class demographics. That is the target demographic that you want. You want to show up to an apartment complex and see that there's not a lot of cars in the parking lot during the middle of the day. Those are the people who are out working. Those are the people that have money to pay their bills. And like I said, with the A-class properties, they generally have lower returns. I'm not saying it's a bad deal, but those are new construction. They're very expensive. They have lower returns on the front end. I also recommend that you look for what we call value add properties. So you want to look for a property that's stabilized with value add potential. You want to be able to increase the occupancy a little bit. You want to be able to raise the rent. You want to do unit renovations and raise the rents. You want to look for other income opportunities. Can you do washers and dryers? Can you put in private yards? Can you put in an internet or cable contract? Those are things you can do to improve the income coming to the property. You want to optimize expenses. Is there an opportunity where they're spending money on something maybe they shouldn't, or you can reduce those expenses? And you want to target properties where the income already covers the debt. This is a little bit of a complicated process or a conversation, but you can get certain loans that look at what the future value would be in the future operations. But ideally, to get a a good stabilized property, you look for a property where the income covers the debt, specifically where the debt service coverage ratio, the DSCR, is 1.25 or higher. The next thing is the market selection. So what makes a really, really good market? Landlord and business friendly states. You want, number one, the landlord friendly states is because you don't want someone who's going to be in your apartment for 2 or 3 months, trashing the apartment while you're trying to get them out and evicted. Business friendly, because that's where, if it's a business friendly state, people are going to move there. There are jobs. You want to invest in an area where there's population growth. High population growth is another one. You want to invest in an area where there's high population growth, landlord and business friendly, and where there's a low median housing costs, meaning you want an affordability gap. You want where it's cheaper to rent than it is to own a home. Now, more and more, that's the case. I think on average, nationally, there's about a $1,200 to $1,500 gap between owning a home and renting. And until interest rates come down a lot, which I don't think they will for the foreseeable future, it's going to be a lot harder for people to own homes. And what we saw is that home prices really haven't come down. It's anybody that owns a home, they're just not selling at the moment unless they need to. But to go buy a new home, interest rates are 2 to 3 times what they were a few years ago. And it just makes it that much harder to buy a house. And that's why renting is more appealing for more and more people. Let's talk about markets really quick. I would suggest that you focus on Texas, Florida, Arizona is also another good one. Georgia, Colorado. Sometimes a little hard to get into Colorado just because there's not large metropolitan areas. Ohio, the same story. Good population growth, business friendly, landlord friendly. But sometimes the MSAs, the metropolitan areas, are a little bit small. Oklahoma, Carolinas, and Florida, like those areas are historically, they've been really good areas. Let's talk about investing in your backyard. I don't have a problem with investing in your backyard. Now, I haven't, as of the time of this recording, I haven't invested in my backyard. I live in California. Now, a lot of people poo-poo on California, but where I live is not San Francisco. It is not Los Angeles, and we don't have the rent control issues. It's also an area where there's a lot of population growth. It's also an area where vacancy on average is about 3%. So if you just take a look at those things where it's business friendly, there is population growth and there's high demand for apartment complexes, it might make sense for me to start looking in my own backyard. Even though it's California, you have to understand there's pockets within certain states and markets that the submarket is very different than what you're looking at in the rest of the area. So invest locally if it makes sense. If you can find an area that's landlord and business friendly, that's a plus. If the housing is affordable, then that's also good. And if there's strong job growth, population growth, that's also good. If you don't live in an area where that's the case, then you need to consider investing out of state. For you to invest out of state, you either need to have a partner that can be boots on the ground. If you're going to be a general partner, you're going to do deals, you need a partner who can find those deals and be the boots on the ground, or you need to be able to fly relatively easily to get to one of those areas. My criteria is one flight. I don't want to do connecting flights to get to an area I'm investing unless I have boots on the ground. If you're a passive investor, I would make that part of your criteria. Is there somebody who's boots on the ground who can go physically visit the property relatively frequently? That is important. I have learned the importance of having someone local, boots on the ground, visit the property. It definitely helps with what happens at a property. So with that, I just want to talk to you really quick about the benefits of multifamily investing. What you get with those frameworks is consistent double-digit returns, even in fluctuating markets. And that's what's great about it, because once you have the apartment complex, it really doesn't matter what's going on in the market. As long as people still have jobs and they're able to, keep working, people still show up and they still pay the rent. They still need a roof over their head. You get higher returns with relatively low risk. So if you look at alternative investments, you have oil and gas, you have Bitcoin, you have things like collectibles, antiques. There's pros and cons to all of those, but multifamily investing checks a whole bunch of boxes and it includes tax benefits. So you get really good returns for a lower risk than most alternative investments. And then also, and I keep saying this, but leverage professional management is huge, and other people's money, because when you do these large apartment deals, we syndicate, we pull people's money together. We're able to buy deals larger than what you could afford on your own. So real quick, closing thoughts on this episode. Follow these formulas. If you do these things, you're going to get higher returns and you're going to lower your risk. Invest in B and C class properties in the markets I listed where there's population growth, job growth, business friendly, and landlord friendly locations. And if you do those things, you are setting yourself up to have really good returns on these types of investments. Thanks for tuning in to the Stephen Lee Thomas Show today. And if you found value in today's episode, then I have a favor to ask you. Please share it with friends, family, and anyone who might benefit from the insights we shared today. Also, don't forget to subscribe and leave a review if you enjoyed the show. And if you aren't already part of our school community, then head on over to school.com/multifamilymasteryhub and join today. And again, thanks for tuning in, and I look forward to connecting with you in our school community.